Hello everyone and welcome back to the Accounting Desk. In today's lecture, we will discuss IFRS 9 financial instruments. Financial instruments such as loans, receivables, bonds, and investments are very common in business. Proper accounting for these instruments is essential because they significantly affect a company's profit, financial position, and risk exposure. IFRS 9 was introduced to replace earlier standards and provide a more logical and forward-looking approach, especially in areas like impairment of financial assets. In this lecture, we will cover classification of financial assets, measurement rules, and the impairment model. We will also discuss financial liabilities, hedge accounting, and walk through some practical examples. The objective of IFRS 9 is to establish principles for the recognition, classification, measurement, and impairment of financial instruments. The standard aims to provide users with useful and relevant information about financial assets and liabilities. IFRS 9 introduced major improvements, particularly a logical classification system and a forward-looking impairment model. Under IFRS 9, financial assets are classified based on the business model for managing the asset and its cash flow characteristics. There are three main categories. First, amortized costs. This applies if the asset is held to collect contractual cash flows. These cash flows must represent solely payments of principal and interest. Examples include trade receivables and loans. Second, fair value through other comprehensive income, or FVOCI, for assets held to collect cash flows and for sale. Third, fair value through profit or loss, or FVTPL. This includes trading investments and derivatives. Measurement depends on classification. Amortized costs uses the effective interest method, while FVOCI and FVTPL use fair value. Fair value measurement guidance comes from IFRS 13, ensuring financial instruments reflect their current market value. A key feature of IFRS 9 is the expected credit loss, or ECL model. Companies must now recognize expected losses in advance. Companies must estimate losses based on historical data, current conditions, and forward-looking information. There are two approaches: the 12-month expected credit loss and the lifetime expected credit loss. For example, if credit risk increases significantly, the company must recognize lifetime expected losses immediately. Most financial liabilities, like loans and trade payables, are measured at amortized cost. However, changes in fair value due to own credit risk are recognized in other comprehensive income. IFRS 9 also improves hedge accounting, aligning accounting treatment with risk management practices. There are three types of hedges: fair value hedges, cash flow hedges, and hedges of net investments in foreign operations. Suppose a company gives a loan of $100,000. If the expected credit loss is 5%, they must recognize a $5,000 loss. The company recognizes this even if the borrower hasn't defaulted, reflecting the forward-looking nature of the standard. In summary, IFRS 9 replaces IAS 39 with a simpler classification model and better alignment with risk management. Understanding IFRS 9 is essential because financial instruments are a major part of modern financial reporting. Thank you for joining us.